Hello, everyone, and welcome to the CattleFax Trends Plus cow-calf webinar. With a little housekeeping order here, just to make sure that everyone can hear me. If there is someone out there that would be willing to go to your GoToWebinar dashboard and raise your hand to make sure that you guys can hear me. All right, perfect. Thank you, guys. We got that out of the way, so we'll go ahead and get started. So again, thank you for joining us today. My name is Troy Bockelmann. I'm an analyst here at CattleFax, and I hopefully will give you a little understanding, a little insights into what we see in both the grain markets, international trade, and then we'll finish it up with a little bit of a market outlook. First of all, we want to thank Elanco. Elanco sponsored this cow-calf webinar, and so the follow-up hitter here, we got Dr. Mark Hilton. He'll be talking to us about some Elanco products, and we appreciate them sponsoring us and helping us with this cow-calf webinar. So we'll just go ahead and get started with this presentation preview, and we'll start here and we'll just talk a little bit about, we'll have an overview of the current trade situation. As we know, there's a lot of trade uncertainty, trade wars with China, the renegotiation of the US, Mexico, Canada free trade agreement and things like that. And so we'll go just talk about where trade's sitting today. We'll just talk for a brief second about the corn market, what we think we see the corn market going on, what risks that could give to producers going forward. We'll have an outlook for the calf and feeder markets for the remainder of 2019, as well as some long-term market projections. And then Dr. Mark Hilton from Elanco will help us and talk about the feeding Rumensin to bred cows. So we appreciate everyone here today. So we'll go ahead and get started here, and we'll get my clicker to work here, right? And we'll start with just trade. So U.S. beef exports so far in 2019 through July are down about 2.7%. What we're seeing here is just a little bit of a decrease to Japan, down 6%. Canada, we have large slaughter and large cattle up feed up north. So we're seeing a decrease in beef exports to Canada, as well as an increase in beef imports from Canada. So Canada's down about 15% on the export side, but up about 9% on the import side. We're seeing the same thing with Mexico. Mexico's continuing to be a pretty strong trade partner, up 2% through to July, but we're also seeing an increase of about 14% from imports from Mexico. Part of that to do is just due to the genetics of the fed cattle that we have today. So we're producing more choice and more prime product, but on the U.S. marketplace, we still do have a little bit of demand for that select product. Think of your steak buffet type items and some of your processing meats that would use that select products. We're seeing an increase in imports from Mexico. The real thing here is South Korea. South Korea demand, the last couple of years has been strong. Last year, beef exports to Japan were up 40%, but we're seeing a little bit of an increase to South Korea and a little bit of a decrease to Japan. China, we've been averaging about 2 million pounds a month, but the main kind of drag on this export market is Hong Kong, down 33% year to date, as Hong Kong has gotten caught up in the U.S. and China trade war. We're seeing less of that product flow through that kind of gray market channel. Now, one thing we do have going for us here is, we'll talk about here, is the U.S. pulled out of the Trans-Pacific Partnership. The remaining 11 countries started the CPTPP, and they then passed that, ratified it through the countries. And as you see here, this red line on top at 38.5% is the U.S. tariff level of beef into Japan. This kind of orange line with the yellowish boxes would be that CPTPP frozen and chilled beef tariff rate. That's roughly 12% less than what the U.S. tariff rate is into product into Japan. But what we saw recently, or heard recently, was that U.S. and Japan have an agreement in place in principle that should be signed by the end of the year. And what that's going to do for U.S. beef exports is allow the U.S. to continue to stay competitive and go back down and be at the same playing field or same tariff rate as the CPTPP countries like Australia. And so Australia continues to see exports to Japan. It's one of their most lucrative markets. But as you see here, Australia's been focusing on China record imports or exports from Australia to China. And because of that, you're seeing these other CPTPP countries, which includes Canada and Mexico, take some market share away from both Australia and the US into that Japanese market, just due to them tariff rates. So being able to level that playing field will be a boost for US beef exports. And you can see the exports to Japan, US, down about 6% at nearly 30 million pounds. They only spent the first 2 months of the year above year-ago levels. But with that trade agreement, if we get that signed, that'll level that playing field. So we'll continue to see support through that. So that'll be important as we're thinking about US beef exports into our largest market, which is Japan. So continuing on with the trade tensions, we had the NAFTA, the renegotiation of the US, Mexico, and Canada trade agreement. Mexico has ratified that, but the US and Canada have yet to ratify that. It has been stalled in the US Congress, so it hasn't been ratified. But what we did see was President Trump remove the steel and aluminum tariffs for Mexico and Canada. And as a result, Mexico removed the 20% pork tariff on US pork. And that's been a little bit of a boost for US pork exports. We'll talk about China too. We have the escalation of the trade war. US pork duties continue to get bigger. The retaliation duties are now at 72%. But there's a kicker here. We do have African swine fever in China, and that is allowing US pork exports these last couple months to really increase. Through July, US pork exports are up about 2%. Look at the bottom left chart, and you can see that US pork exports to China were 109 million pounds in July, relative to about 18 million pounds a year ago. African swine fever has really been ravishing that country, and so even with that tariff levels, we've been able to maintain a competitive environment in China. And even with this trade war dispute, whatever you want to call it, going on, we're continuing to see pork exports to China. If you look at the upper right chart, that's US pork exports to Mexico. And you can see last year in April, when you go into May and June, that's when the tariffs were put into place, and you saw a significant decrease in pork exports for the remainder of the year, back to the 5-year average after being well above the 5-year average for the first quarter. Now you look at May. May is when the announcement came that Mexico was going to remove the duties for pork exports to Mexico from the US, and we've seen a slight increase or a significant increase in pork exports because of that. Well, now this is the first month, July was the first month where we saw US pork exports to Mexico increase above year-ago levels. And so while we started the first 5 months of the year below year-ago levels on total US pork exports, the last 2 months of the year we've been above year-ago levels, up 2% year to date, but we expect US pork exports to exceed 10% growth here in 2019 based on these two markets here. As you see in the bottom right-hand corner, through July, pork exports to Japan are down about 3%, Hong Kong down 46%, and South Korea down 12%. So these two key markets are the driver in pork export growth here in 2019. So just taking a big picture, this is year to date. So through July versus a year ago, pork exports are up about 2%. Beef exports are down about 3%. At the end of the year, we expect beef exports to be down about 2% after 3 years of 10% or greater growth. So we are starting to see a little bit of global demand weaken for US beef, but as we get the trade resolution with Japan, Mexico, and Canada, and we see some progress, hopefully in the US and China agreement, that could allow more beef to either flow directly into China or through Hong Kong. The other one we want to look at is beef imports, up about 1% year to date. Australia has been a large supplier of beef into the US in 2019, as well as Mexico and Canada. We expect beef imports to be about steady with the year-ago levels as we bring in more of that manufacturing or lean trim beef to mix with our 50s to create hamburger product. So this value-added product here on the domestic market. Total exports up about 1% year to date. So seeing a little bit of growth, which is positive when you have expansion through both all of the pork, the beef, and the broiler productions here. So we'll kind of switch and we'll talk a little bit about grains. This top red line, that's corn. And you can see the USDA estimated that we planted about 90 million corn acres here. And so if you've been watching the corn markets, you saw a rally starting right around that April or May time period and continue into late June as delayed planting and wet weather really slowed down the planting progress, and it stoked fears of not getting the crop in the ground or switching from corn to soybeans. Now, the USDA has suggested that corn acres are 90 million acres, which would be a comfortable supply and demand position for U.S. corn, but there is some risk to this corn market. The first one here, this is your prevented planted acres. And you can see, this is going back to 2007. The prevent plant for corn, soybeans, wheat, other was nearly 20 million acres. And if you just focus in on this little blue bar here, this blue bar for 2019 is just the corn acres. About 11 million corn acres were entered into prevent plant. That is larger than any other total prevent plant year in history. So what does that mean for the corn market today? We made the highs in June. We've come lower. We've broken the $3.50 level in the spot contract, but there is risk because of that. Based on these prevent plant acres, what is that going to do to harvested acres? Currently, harvested acres are sitting around 80 or 81 million acres, and could we see some of those harvested acres decrease, which would be supportive to the corn market going forward, just based on that prevent plant? So if you follow the grain markets at all, corn planted as a cover crop but not harvested for grain would be counted as corn planted but would not be counted as corn harvested. And so while the magnitude and the risk because of the prevent planted acres is unknown today, it is something to consider as we think about the corn harvested acres and the effect that that could have on the total corn supply. The other risk we have out there is yield. The USDA is estimating corn yield at 169.5 bushels an acre. And in our estimation, we could see yield drop as we get into harvest. Corn report comes out tomorrow. We could see a little weakness in corn yield tomorrow, or we could see it come in the October-November report. But as we sit today, and we're looking at stocks to use, and you look at this black line on this chart, that's sitting at 12%. And you look over there, and that's about $4 a bushel. And so on average, you might see a little shoot above it, but on average, when stocks to use are above 12%, you would see spot corn futures prices on average below $4 a bushel. And so if we think about the harvested acres and we think about yield, if we continue to see yield at 164 a bushels per acre or higher with no change in acres, corn would continue to stay above that 12% stocks to use given the current demand situation. If we lose 1 million or 2 acres on the harvested side and yield is a little stronger, we would continue to stay above that stocks to use, 12% stocks to use as well. Now the risk would come is if we lose some harvested acres and we lose some yield, we could see stocks to use tighten to below that 12%, which would cause that rally in the corn market. Now we're not suggesting that we see the corn come back and test the levels that we saw in June, but there is risk of the corn market moving higher than what the USDA projects today, just based on those two factors. So we'll just take a minute and look at that corn chart. So this is December corn futures, and we came in the year right around that $4 level. We seasonally moved lower as we saw some demand erosion and increased supply levels through May. We started getting into May, that late planting started stoking fears of the acreage and the yield potential of the crop. We saw the corn market move about $1 higher into a June high, move lower, and then we got the acreage report and the end of June, another acreage resurvey in August, and we've since seen the corn market move back lower and test that $3.50 level basis the December corn futures, we have a range or a practical low for 2019 with the December corn futures of really that 330 to 350 area. So if you're thinking about that time period, we'll likely go down and test that low, and then we'll have to keep an eye on both harvested acres and yield to see the direction of the market moving forward from there. But if you're just looking at the fundamentals as we have it today, really over the course of the next 6 months, we don't expect corn to be a major input factor. We expect that range to really be the $3.50 or $3.40 to that $4 level basis December corn futures, and even into the March futures, just based on the fundamentals that we do have today. That is what I have for you guys today. Oh, hay prices, I guess I have one more chart. So after the drought that we saw last year, we had really decreased hay production last year. Our stocks really tightened up, but due to the winter that we had and the weather that we've had this spring, we've seen a lot of hay production increase. And because of that, you've seen a really sharper than seasonal decrease in the monthly average U.S. hay price. And so based on your region, your price is probably different than what this is. This is the all hay U.S. average price. And so just based on the region you are and how wet or dry you are in the region, based on your hay production, your prices are generally different than this. It gives an indication of the overall hay market on a national basis. As we're looking through this, just based on making up the stocks that we didn't produce last year, we are expecting the 2019 and 20 average hay price to be about $5 more than we saw in 2018 and 2019. So moving back from those high levels we saw in May and June, moving back towards year-ago levels and trending slightly above year-ago levels. And now with that, we'll switch over to Tanner, and he can talk to you about the cow-calf markets.
All right. Thank you, Troy. Like Troy said, my name's Tanner Aherin, analyst here at CattleFax, and cover the Southeast region feeder cattle and calf markets, as well as some of our smaller feed yard members in Nebraska. So just kind of a quick overview of what I'm going to cover, look at the fall markets for the feeder, fed markets, and the calf markets, and then look into what kind of we expect going into the winter and spring of next year for both the feeder and calf markets, and then take a glance at some of the longer term industry trends. So to start off with, I wanted to first discuss why the Tyson plant fire that we had about a month ago, why that created so much havoc in the markets, and why the markets reacted the way they did. As I'm sure you are all aware that we have been expanding the cow herd since 2014, had a low around 29 million head, peaked, and we're reached close to 32 million head this year, and expecting about another 100,000 head as we start 2020, and we'll probably flatten out over the next few years. And then obviously, if you're going to expand the cow herd, you would expect increased fed steer and heifer slaughter. As you can see, we made a low around 23 million head in 2015. And then we have since increased, and we're expecting to slaughter around 26.5 million head in 2019. That's a 300,000 increase from the prior year. As we look into 2020, we expect about another 300,000 head to be harvested. And as you can see as we were liquidating the herd from 2010 and decreasing slaughter down to 2015, we ended up closing 4 different packing plants between 3 years. And as a result of that, and since the low in 2015, we have not seen any major packing plants come back online. And just for reference, on a 5-day work week back in 2012, we could harvest roughly 525,000 head. Our estimate for 2019 is roughly 483,000 head during a 5-day work week. And as you can see there between the different bars, we're expecting about an additional 700,000 head to be killed this year compared to 2012. So get back to my pointer here. So obviously, this is what this chart is showing. It's looking at the packing plant utilization based on a 40-hour work week. And you can see here in 2019, we're running at 106% of the shackle space that we have. So where do we come up with that extra 6%? Well, a lot of that is slaughter that occurs on Saturdays. And when you think about what we've done since the packing plant fire, we've actually had adequate kill levels, but like I said, a lot of that has come on Saturdays. We've been averaging roughly 60,000 head on Saturdays, which is the largest we've seen in several years for non-holiday Saturday weeks. And then for that to occur, the feeding segment has had to give up some margin to the packers as well. But Tyson has announced that they do expect the packing plant to come back online by the first of the year, which could give the cattle feeders a chance to gain back some of that margin. So what has this done to price? Before the fire, we expected a low to be made right around the buck to $1.05 range this fall. But based on our current analysis, we expected the packing plant fire to take off roughly $5 to $10 for the fed market, which would put risk back down to this $95 to $1 range. You can see here, based on all the consolidation we've had back in 2008 and 9, we have a lot of strong support in that 90 to 95 area. Don't expect it to get any cheaper than that. But we recently took out the long-term trend that started back in 2009 and went off the lows back in 2016. But as we go look ahead, we do expect, looking into 2020, we expect the full range of this 95 to 125 range, likely having the highs occur in the spring and then risk back to 95 later in the summer and fall. There's one thing that we are concerned about, though, as one reason why we may not reach that 125 level, and that is if we lose currentness in the fed market. Luckily, we came into this situation after the packing plant fire. We came into this very current. People were marketing cattle on schedule or even ahead of schedule, and this was supported with lower carcass weights all the way through the summer. And but the risk is, do we end up slowing slaughter levels, and do we ever start to build a front end supply? And if we do start to build a front-end supply in the fed industry, that could make this situation or this event have a longer tail to it. We'd start to back up cattle, end up having a big supply, and that could, make us fall short of the 125 level next spring. This chart here is a measurement of the leverage component, looking at the fed price minus drop credit as a percent of the composite cutout. It's another way of looking at the margin situation as well between the feeding segment and the packing segment. And as you can see on the 2019 line, we were comparable to a year ago as far as leverage goes. But then after the event of the fire, we've seen leverage kind of fall off the table. Margins have transferred between the two different segments, and and we've come back to the low 40s, which we haven't seen for quite some time. And as we work through this, we think that the 42 to 45 area is short enough for is low enough for the next couple months. And another way that we get the $95 range for the low in the fed market is we think the composite cutout does have risk back to 200 to make the seasonal lows. You take that times 43%, you get 86, add back your $9 drop credit, and you end up with $95 for your fed market. We think that's plenty cheap. We may not even have to get there, but it's just one way of us coming up with a way to potentially price in the lows. As we transition into the feeder market, here we're looking at the CME feeder cattle index on a weekly basis. And this is basically represents an 800-pound feeder steer. you can see back in the April, May time period when we had that corn rally, we saw a pretty big drop in the feeder and the calf markets as well. Just your cost of gains increase in the feed yards. They're going to pay less money for the feeder cattle. And then over the last few weeks, we've trended lower. But if you look at the 10 and 20 year seasonal, they both are pretty similar. We should be steady to slightly lower into the year. And I think that is a pretty good chance of how the market performs as we go into the next calendar year. And then looking at the seasonal as we get into the first quarter, that's typically when you make your cash flows for the year. Here we're looking at the same thing. It's on a daily basis. You can see I've drawn, I think, a practical range for the next 6 months is this low 30s to low 140s mark. And as we go through this, the next 6 months, we may not probably won't have to spend a whole lot of time below there, and may not spend much time at all up in the 140s. But when you think about the feeder market, you need to think about when these cattle will be harvested or what live cattle contract they will be placed against. Within the next 30 to 60 days, we will likely be should start to place cattle against the April live cattle contract, and that has the largest premium when you're looking at the deferred contracts. It's currently trading in the mid-teens. And right now we can roll a 800-pound steer back about 20 to 25 bucks, or the break-even price is about $20 to $25 lower than the purchase price. So if we've got April live cattle in the mid-teens, that would say we can keep the CME index in roughly the mid-130s to low 140s as well. But as we transition in the next calendar year, we're going to start to place cattle against the June and the August live cattle contract. And if you roll those back 20 to 25 bucks, that would put you in this low 130 range. Typically your June and your August live cattle contracts are heavily discounted compared to April. So say if they're at 110, that gets you in the 130 to 135 range. Now I'm going to transition into the calf market. I wanted to start off with giving you guys an update for the drought monitor. I've got last year's drought monitor at the end of October, and then I've got the most current one at the beginning of September of this year. And you can see here in the Southern Plains last year, basically very little drought conditions there. That supported the calf demand for winter grazing, helped out the calf market as we worked through the fall run. As you transition to this year, though, it's a different story. We're starting to see some drought pop up in the Southern Plains and a lot of your winter wheat regions. As a result, that could limit demand for your calves. It's one less buyer out there in the market that's looking to purchase cattle. On the flip side, we do see the Northern Plains. They've had adequate moisture, a lot of forage up there. As a result, they could keep their calves out on grass longer or delay their weaning. And as a result, this could allow these calves to come to market later, spread out the fall run supply. Now, I've talked a lot about the margins within the feeding segment. You can see here we've recently surpassed the -200 per head area. We have not done that since 2015 and 16 when it got about as extreme as it ever has. But it is a lot worse than we have seen in several years. If this were to continue, this would adversely impact, or has risk of adversely impacting the suppliers. Simply, they're just going to buy cheaper feeder cattle or cheaper calves, essentially just taking leverage away from the cow-calf and the feeder and the feeder cattle markets. And just another point, we do see break-evens in the upper teens as we finish out the fall, and some of them even maybe up above the 120 mark. So that's something that we're definitely keeping an eye on for sure. Now, when we look at the we're looking at the CattleFax U.S. average 550-pound steer price. And as I'm sure most of you know, we typically make our lows here in the fall, and then we come back and rally in the spring. Based off of what I've laid out over the last few slides, I think there is risk that we go back to this mid-140s area. That's just, as we've worked through the cattle cycle, steady to larger supplies, big losses in this profitability losses in the segments above, and then just we've currently had just a negative market psychology over the last few weeks. We have recently come out of that, but we're still have a lot of work to do as we go forward over the next couple months. Now, if we were to only go down to the low 150s area, I think that would be a result of the fact that we do spread out that fall run supply because of the Northern Plains calves not all coming to the market at the same time, flooding the market. And it could be a case where we get down to the 150s or low 150s, and then we just trend sideways for the next 30 to 60 days. Now, if this were to occur, it may be a case where we do not have as big of a rally into next spring, next March or April. And I think that would be similar to what happened in 2018 and 19. We never really saw a real deep fall low last year. Typically, from your fall lows to your next spring highs, you have about an 18% rally. Last year, we only saw about a 10% rally. This is one, it could be the same situation that we see again this year. And if we were to go to 145 or 150 and see about a 10% rally, that'd put you there in the low 170s. And looking ahead into the full calendar year next year, we expect a full range of basically 145 to 175. Obviously, with your lows coming in the fall, your highs typically coming in the spring. But there's still a lot of water to run under the bridge between now and the end of next year. And there's obviously a lot of factors that could play a role in not meeting those expectations, but that's what we have penciled in for right now. So we've been getting this question a lot. Should I retain ownership on my calves or my feeder cattle? And based on where we are in the cattle cycle, I think it's maybe something that everyone should consider, or at least analyze a little closer. One reason why you may retain ownership gives you the chance of improving your bottom line. And I've put emphasis on the heifers, and I'll show a chart in a second and why I say maybe you look at it for your heifers. Gives you some flexibility, increase the marketing windows. You can gather some performance data on your current genetics and could help with your future genetic decisions. And then you potentially participate in some value-added programs as well. Now, when you think about retaining ownership, this could involve going through the backgrounding or grazing stage, or potentially all the way through the feeding segment. But I do want to point out that there is still risk. This is not guaranteed to improve your bottom line or improve profitability. There's certainly still risk out there if you do something like this. So I mentioned that we are seeing a pretty big discount on the heifers in 2019. Basically, your 550-pound heifers are discounted about 13.5% compared to your steer price. Now, I think that's just a result of the fact of where we are in the cattle cycle. We're seeing a bigger supply of calves come to market, both steers and heifers. And so obviously the buyers are going to prefer those steers over the heifer calves. So if we were to get as cheap as 145 this fall on a steer price for a 550-pound steer, that would put your heifers back in the mid 120s. We're basically seeing a $16 to $22 discount as we've gone through the year. And so it's one thing to consider. Maybe you look at retaining ownership on those heifers through the backgrounding or grazing stage to maybe add some value to them. And another thing you consider about on your heifer calf crop based on where we are and the big discounts, maybe you think about retaining more of those heifers as replacements. You cull some of those older cows that you have in the herd that you've been thinking about getting rid of, but you haven't yet. Maybe this is the right time to do that. Bring in some new genetics and better genetics that should hopefully push your cow herd forward as you go over the next few years. So this chart here, we're looking at what the market is paying for you for adding weight. So basically taking a October 550-pound steer, adding 300 pounds, and selling it again in February. And you can see over the last 10 years, the market has paid $282 a head. Now that's not all profit. That's just the revenue that you get from doing that. So if you take that, it brings you to a break-even cost of gain of 94 cents a pound. So in other words, if on average you could put on weight for less than 94 cents a pound, you were profitable. Obviously, there's a lot of variation between the years. 10 years ago, your cost of gains would have been roughly, your break-even cost of gains would have been roughly 85 cents. But then here in 15 and the 16, would have been pretty tough to be profitable and add value to your calves. You know, break-even cost of gain at roughly 29 to 30 cents. You can see my estimate for this year from the fall of 19 into 2020. Expect the market to pay, give or take, $250 a head. That's a break-even cost of gain of about 84 cents a pound. Now, that means that cost of gain has to take into account everything. That includes death loss, any other medicines you have to pay to treat sick cattle, any interest costs or anything else. So make sure you take into account that. And the way I got that is I used $145 for the calf price and then used $30 for the March feeder cattle futures and adjusted for basis during that February time period. And you're probably wondering, is that $1.30? Is that a reasonable price for the March futures by the time we get to February? I think the simple answer is yes. That 130 to 135 range seems pretty practical by the time we flip over to the next calendar year. Here we're looking at the spot feeder futures from 2011 and 2019. And you can see over the last couple years, we've spent most of the time between $1.40 and $1.60. You know, obviously there's a little stretch where broke below that level, but we spent the bulk of the time in that $20 trading range. But as we've transitioned to 2019, we have since fallen below that level, created some resistance in the low 140s, but we also have very strong support at this 120 area. So going forward over the near future, I think this 120 to $140 range could be our new trading range, at least for the time being. Just one last chart that I wanted to discuss and give everyone an update on, looking at the seasonal utility cow price. You see typically make our lows in the fall as we go through our peak supplies. This year we've traded pretty close to the seasonal index, and we think a seasonal index works about 8 out of 10 years. So far it's been working pretty good. We did have a little volatility back here during some of the winter weather events, but going forward we do expect to break pretty hard going into the fall, and we do think there is price risk below this $50 area. And we have not traded below that $50 mark since early 2010. And the reason we think there is risk back to that area is the cull cow market or slaughter cow market is going through a similar scenario as the fed market is. Basically, we have limited packing capacity out there. Leverage is definitely in favor of the packing segment. And then you throw in another variable. Right now we're seeing record large fed packing margins, and there are some cow plants out there that can kill both fed steer and heifers. So if those record margins continue through the rest of the year, we could see some of those two-way plants be incentivized to kill more fed steer and heifers than they do cows. That would further create the issue of the packing plant capacity even further. So as I wrap things up, just kind of want to discuss some longer term outlooks, some things that are on our radars, things that we're keeping an eye on. We do expect record beef and competing protein production at least through next year, maybe even further on down the road. And as a result of this, it just confirms how critical the strong exports and increased market access is. We need some way to move this product off the domestic market, alleviate some of the price pressure. And then obviously African swine fever, we think it'll be a wild card next year. It's hard to figure out exactly how it's going to play out and how it's going to affect the U.S. markets. We do think it'll be beneficial to the protein markets, especially the pork and poultry, as a cheaper substitute compared to beef. But we do think it will indirectly support the beef markets as well, whether we're backfilling some different countries, or if we are able to move a little product to some of those countries that are affected by African swine fever. There's a lot of speculation out there that there is a recession right around the corner. If this were to occur, we'd see a negative impact to beef demand. It's seen as one of your higher quality protein, one of your more luxury items, I guess you'd say. And as a result, you'd see some of your consumers pick your cheaper proteins, that being chicken and pork. When we look in a little closer at the cow-calf industry, we do not expect the input cost to decline over the next 12, 24 months. If you want to consider female replacement prices as an input cost, we do expect those to get lower though over the next 12 to 24 months. Basically, there's just a bigger supply, less demand as we're reaching the end of the cattle cycle. Fewer people are expanding their cow herd. And then the cow-calf industry in particular does have cyclical price risk. Simply, we'll see steady to larger supplies, and then we'll probably see some leverage shift among the different segments in the cattle industry. So with that, I'll turn it over to Dr. Mark Hilton with Elanco. Once again, we do appreciate them sponsoring and working with us on this event. I think they have a lot of beneficial, useful technologies and products that they have to offer, and I think they always provide some good insight when they present. So with that, Dr. Hilton, I'll turn it over to you.
Thanks very much, Tanner. I appreciate that, and thanks, Troy, for your words of wisdom too for our folks. And Tanner, I just want to say I really appreciate your information on the retained ownership. I sure talked to our beef cow-calf producers about that, and although you didn't guarantee it, you said, hey, this is a year you need to take a look at that, and I appreciate that. So yeah, thanks very much to CattleFax. We at Elanco sure enjoy sponsoring these programs and really appreciate the feedback that we've gotten from people, and I encourage you to do that. My email's right there at the bottom, and the last slide will have that also. So we want to talk about feeding Rumensin to beef cows. Here in the U.S., the Elanco has a great history in the feedlot industry and well known, fed to almost 90% of all feedlot cattle. Rumensin's been approved for beef cows for many years, and we find that a lot of people aren't aware of that. We only have about an 11% market share, so we'd sure like to see more cows getting fed Rumensin, and I'll talk to you about the economics of that in just a minute. Because if it's not a benefit to the cows, we're not going to be talking about something like that, because we're wanting to partner with the cow-calf producers. My folks have cow-calf. I grew up with that, so we sure want to look out for those producers. Replacement heifers, we'll talk about that first, then we'll talk about mature beef cows, and then delivering Rumensin in a spray that we did a research project on. So on replacement heifers, this has been on our label for many, many years, and lots of replacement heifers, beef and dairy, get fed Rumensin, and these beef heifers have fewer days to first estrus, which means those heifers generally breed earlier their first season and then calve earlier throughout their lifetime. And as in the feedlot, Rumensin prevents and controls coccidiosis. This was a study that was done down in Texas a number of years ago. They looked at 5 different herds over a number of years, 1,500 calvings. And what this showed was how important reproduction was on heifers. If a heifer calved in the first 21 days of her life, or in the first 21 days of the breeding season, her return on investment over her lifetime was 10.7%. If that heifer dropped down to getting bred the second 21 days and calving in that second period, 21-day period, pretty much a break even. But when you got into these heifers that calved late, they lost money. So if we can use a product like Rumensin to get more heifers to calve in these first 21 days, that's a winner for that heifer for the rest of her life. So we think it's a real plus to feed Rumensin to these heifers. Now in the cow herd, like I said, less use out there. Here's the label for Rumensin. It is the only ionophore approved for mature reproducing beef cows. It improves feed efficiency and maintains that body weight on 5 to 10% less feed. Also prevents and controls coccidiosis. Here's a trial that was done where they fed the cows 0 Rumensin, 50 milligrams per head per day, and 200. Weight change on these cows was essentially the same, but here's the bottom line. The cows that got 200 milligrams of Rumensin per head per day, and this was a 171-day study, so it was through the fall and winter on some bred cows, those cows ate 11% less feed and gained the exact same amount of weight, or had the same weight change. So right in our 10 to 11% is what we talked about. Now I know Troy mentioned average hay price was going to be $165 a ton, and we know that's not representative of beef cow hay. It's going to be slightly lower than that. So I'm just going to use the $130 a ton here, our last bar, as an example. What this is showing is this trial was done for 112 days, and the cows were fed, and in this example, if the hay cost $130 a ton. So 112 days of Rumensin to a beef cow is going to cost somewhere between $2.25 and $3.50. So let's say $3. So in 112 days of feeding that beef cow, your cost of Rumensin is $3. Now I like to say, hey, if you took $3 and opened up a bank account, put it in the bank for 112 days, so about 3-4 months, went into your banker and said, hey, I want to close out my account after 4 months. I put $3 in 4 months ago. How much money am I going to get? Well, probably $3 and a penny. So not much of a return on investment. If you take that same $3 and invest it with your feed dealer on Rumensin, the cows return you $26. So a $26 return on investment versus a $3.01. So to me, this puts Rumensin really in that no-brainer category for feeding the beef cows during the winter. I was actually at a meeting and I said to somebody, I said, the only reason as a producer I wouldn't feed Rumensin to my beef cows is if my neighbor's bringing me all my feed for free every day. Well, a guy stands up and raises his hand in the back of the room and he says, I'm going to have to disagree with you on that one. And I'm thinking, why would you pay for the Rumensin if you're getting all your feed for free? So I asked him and he said, I'd have the neighbor keep bringing me all my feed for free, but I'd go buy 10% more cows and I'd buy the Rumensin. I looked at him and I said, well played, you got me. So again, tremendous return on investment for feeding Rumensin. When Rumensin was labeled for beef cows, we had to go through safety studies to make sure that Rumensin did not negatively affect reproduction. So in this trial, no Rumensin fed. The conception rate on the cows was 80.7. When 200 milligrams per head per day of Rumensin was fed, 91.9% conception rate. So as you can see from this research, Rumensin does not have a negative effect on reproduction. So we were able to have that on the label. So here's our research project that we did. I'm going to actually bypass this slide. This just tells the different ways you can get Rumensin into the feed, because I talk about it later. So we found out there were some producers that had put a commercial spray unit on their hay processors, and they were spraying on a liquid urea molasses Rumensin product. So the objective of our study was to evaluate the accuracy and consistency of a liquid Rumensin application in a molasses supplement on these processed hay bales. So our hypothesis was that if we sprayed this on the hay bales as they were being processed, we would get a nice uniform consistency of Rumensin, so the cows got between 50 and 200 milligrams per head per day, which is our label claim. So here's the sprayer on the hay processor, and here's us. Here's one of the windrows in February up here in North Dakota, and we're cutting sections of this hay out. And this is a little video of the machine. So the Rumensin spray started right as he started the tractor, and then would finish when he was done with the bale. But that shows the processor. So this was a herd in North Dakota, 195 cows. We weighed the round bales of hay, and the hay bales averaged 1350, and this was done the winter of 18 and 19. So the liquid supplement was a commercially based product, molasses product with urea, vitamins, minerals, and Rumensin. And again, it was applied during the processing as that hay is coming off the processor before it hits the ground. That's when it was sprayed on there. And I mentioned when it was started and stopped. We targeted 125 milligrams per head per day. The hay was tested, and based on the amount of urea, that was the amount that they wanted. And we also looked up some research and said how much hay is wasted when it goes through a processor and is fed off the ground, and the research said 15.3% of the hay. So we took these samples in December, February, and April. We cut an 18-inch section out, and you can see this is Sarah Lenine, nutritionist, PhD nutritionist on our team, cutting out a section of the hay when we were up there in February when it was 17 below zero with wind chill. Frank White, another PhD nutritionist, he drew the straw to go in April, and he's measuring the windrow to make sure we get it at the right place. We cut out a section at 25, 50, and 75% of the length of the windrow. These averaged about 12 pounds. We put these samples in a bag, took it back to the shop, cut it some more, mixed it up, and sent a 3-pound sample to the laboratory. So in December, when we went there, our results were higher than we expected. And what had happened was the machine hadn't been calibrated in a while. So they recalibrated the machine. We went back in February and in April, and you can see we're right on our target label of 50 to 200 milligrams. And the results were exactly what we'd hoped. So our conclusion was this commercial spray unit, appropriately calibrated by the manufacturer, can be used to deliver an accurate on-label amount of Rumensin to hay bales that are fed using a bale processor. So the summary was it's safe. We got the amount that we wanted. Actually, 94% of our samples in the study gave between 50 and 200 milligrams per head per day. And again, this is the label for Rumensin. What we also did was made a calculator. So this is available to all of you. We're going to have feed dealers, our veterinarians, our sales staff have these calculators. So you can use this to find out, is Rumensin a good value for your cows? So in this example, we've got the cost of the supplement with Rumensin at $200 a ton. It's giving you 100 milligrams per pound. If you bought Rumensin without, or excuse me, if you bought a supplement without Rumensin, $180 a ton, 100 cows, 150 days. Again, I'm a bottom line guy, so I'll go right there, through that 150-day time, we saved by eating Rumensin, we saved the owner almost $2,700 worth of hay for a return on investment of nearly 900%. So I'm sure most of you, all of you, would invest your money if you were going to get 900% return on your investment. So in this example of this 150 days fed in this 100 cow herd, the owner saved 24.3 tons of hay and about a half a ton of grain. So if you would like this calculator, please send me an email, and again, that'll be coming up. So Rumensin can be delivered in a variety of options. If you're using a TMR for your beef cows, it's really easy. Buy it in a mineral mix, commercial protein, or a liquid supplement. If you're feeding distillers grain or a corn gluten ration, almost every one of the feed companies have these co-product minerals that are really high in calcium to balance out the phosphorus. If you're feeding hay along with cake or protein cubes to your cows, you can have your elevator, your feed store make cake or protein cubes, whichever you call them, with Rumensin in it. If they're not doing that already, you can request that, and most of them can make it. And our research says that we've got a new way to put Rumensin onto a hay bale by spraying it onto these processed bales. So again, there's my email, w.mark.hilton@elanco.com. If you are interested in the calculator or have any other questions, give me an email or call your Elanco sales rep. So guys, thanks a lot for letting Elanco be part of this. I appreciate it.
Yeah, thank you, Dr. Hilton, and thank you for taking time out of your busy schedule and joining us for the webinar. I think there's a lot of good, useful information there. As we transition and wrap things up, I just wanted to point out a few upcoming CattleFax events that we have scheduled on the calendar. We have our Outlook and Strategies meeting coming up December 3rd. That'll include a lineup of guest speakers as well as us presenting. We've got a speaker from Rabobank International giving us an outlook on the global and U.S. economy. We'll also have Brett Stewart from Global AgriTrends give us some projections on the global protein supply and demand. And then, of course, we'll wrap things up that day and give our price forecast for 2020 and beyond. And then we have another Trends Plus cow-calf webinar scheduled for January 29th next year. Hope you guys can join us. And then we'll do our annual cow-calf survey that'll be released in the mid to late January and run through February. So if you're interested in that, be on the lookout for that. You can find any of this information about these different events at our website at CattleFax.com. And then some final remarks. If you guys have any questions about the webinar or any further questions that pop up, feel free to send myself or Troy an email. It's the initials of our first name and then our last name at CattleFax.com. If you have any questions for Dr. Hilton, you can send those to us as well, and we could forward them on to him. With that, I appreciate everyone joining us, and hope you have a great evening.